Good afternoon, and welcome to the first part of Sensible Financial Planning's two-part webinar series on bonds. My name is Bobby Carlton, and I'll be your moderator. Today, Sensible Financial's founder, Rick Miller, will be speaking about bonds, their safety, and their risks. Rick holds a PhD in economics from the University of Chicago and started Sensible Financial 20 years ago. He is also a certified financial planner. This is the first of two webinars in Sensible Financial's series on bonds. Today's webinar will address the recent investment performance of bonds. In next month's webinar, Rick will discuss Treasury inflation protected securities, or TIPS. You can register for upcoming webinars through a link in Sensible Financial's May newsletter, which will be published later this month, or at www.sensiblefinancial.com/webinars. Please submit your questions through the Q&A link at the bottom of your window. Rick will answer as many questions as he has time for, once approximately midway through the webinar and once at the end. Unfortunately, he cannot give personal advice in this setting. There just isn't time to gather the information and context necessary to do so. We will provide contact information for Rick at the conclusion of the webinar, and we'll be sending you a link to the recording as well. Now, Rick will start by summarizing the agenda for the webinar. Rick?
Thank you, Bobby. This webinar will examine the role of bonds in your portfolio. We'll start with a quick review of what bonds are. Then we'll move on to factors that influence bond returns. We'll consider some popular ideas for responding to bond risks, and then we'll assess rising interest rate implications for both your portfolio and your financial plan. So we're going to start with the bond and what it is. This is a picture of a real bond. Don't try to copy and cash it, though. It matured almost 30 years ago. And the picture illustrates some basic bond concepts. And I'm going to attempt to highlight them here. So we have the face amount. That's the principal payment to the holder when the bond matures. In this case, that's $100,000. The issuer is the borrower. And in this case, it's the United States of America. The coupon is the percentage of the face amount paid to the holder each year. It's the interest rate. For this bond, it was 10 1/8% right here. And the issue date is when the loan was made, and that's October 18th, 1979. And the maturity date is when the loan is due. And in this case, that was in November of 1994. And all bonds have characteristics of this sort, and the characteristics determine how much the bond is worth. They determine how much return owners will receive, and so on. So what returns do bond owners get? Bond owners get two kinds of returns. They get interest and principal. Now we're looking at a slightly different bond, a simpler bond. This is a 10-year bond. And let's see, it says so what? I want to get this here. So we have a 10-year bond. And I'm sorry, I went a page too far. One moment. Here we go. So now we're looking at this 10-year bond, and it pays 5% interest semi-annually. So 5% of 1,000 is $50 annually, or $25 each 6 months. And if the interest and the principal are paid, the bond owner or the lender gets what they expect. Well, that sounds great. And it usually is great, but sometimes things go wrong. So let's think about what could go wrong. The first thing, a set of things that could go wrong, are basically that the borrower might not be able to pay. This is called default. And it could be as simple as the borrower being late with an interest payment. if something like this happens, lenders tend to get pretty unhappy because their expectations are not being met and borrowers are penalized. Corporate borrowers, company managements can get fired, and country and municipal borrowers may not be able to borrow more, or they may face much higher interest rates the next time they try to borrow. Either way, the lenders are likely to get less than they expected. They lose, and they lose real money because they don't get the interest that they were told they would get, that the borrower promised, or they don't get all the principal back the way the borrower promised. Now, the second thing that can happen, and what we've experienced most recently, is that interest rates can rise. And when interest rates rise, bond prices fall. And I'm going to use what's called a zero coupon bond to explain that. And a zero coupon bond, it has all the characteristics of the bonds that we just discussed, with one small difference, and that is that the coupon is not stated. There is no coupon payment. There's no monthly or quarterly or semi-annual or annual interest payment. The bond simply returns an amount of principal when it matures. So there's a promise to pay a fixed amount at the bond's maturity date, and there are no interest payments between purchase and maturity. And in that case, the bond price is set so that the lender is made whole for whatever interest they would have gotten in that final payment. And the only thing that can adjust is the issue price. And it adjusts so that the total payments that the lender would receive are the same as if there were a coupon. So that in this case, if the interest rate is 1%, the price is set at $905. And if given that the payment back will be 1,000 at 10 years, this is equivalent to the bond being issued with a face amount of $905 and getting a 1% coupon each year, and then $905 back at the end. It turns out that that price is exactly equivalent to this, sets that the $1,000 payment equal to the stream of payments that would have happened if there were a 1% coupon on a $905 bond. If interest rates are 2%, then the equilibrating price is lower. It's $820 and so forth. The higher the interest rate, the lower the price of the bond. So if interest rates were to rise, then the price of the bonds would fall. So if we started with a 1% bond that we bought for $905, and then the next day interest rates rose to 2%, people would only pay $820 for that bond. Investors would only pay $820 for that bond. So in that sense, the lender loses. However, borrowers are still keeping their promises. They're still paying that $1,000 when it's due. So lenders aren't losing, they're just disappointed that they didn't get the higher interest rate that they could have gotten if they had just waited a day. They're also losing if they were intending to sell before the maturity date, and we'll talk about this in a little while. Now, the third thing that can go wrong is inflation. Inflation can reduce interest and principal purchasing power. So the lender is getting all of the payments that they expected from the borrower, but those payments are worth less. And the borrower says, the borrower says, I'm making the payments that I promised. And the lender may say, well, gee, they're not worth as much as I thought they would be, but the borrower is fulfilling the contract. And there's no good solution to this problem for a specific bond. There are types of bonds that respond better to inflation, and we'll talk about those in our next webinar. But for the purposes of this one, for standard, what are called nominal bonds, where the principal and interest payments are specified in dollar terms rather than in real terms. The borrower is fulfilling the contract, and the lender is not as well off as they expected they would be. Okay, so now let's think about bonds and bond returns, and let's think about what's been going on. And here we're going to look at a long period of time. This is the last almost 50 years. And we're going to look at the Bloomberg Barclays US Aggregate Bond Index, which we use as our bond benchmark for our portfolios, but it calculates the returns of almost all US bonds as if we went out and bought every US bond available in the market in proportion to their size or value, then we would get the Bloomberg Barclays Index, and these are the returns that we would have got. So the gray line shows the annual return of the index. That's, let me see here. So this is the gray line here, right? That's showing the annual return of the index for fiscal years ending March 31 since 1977. It says 76 down here at the bottom, but this is 1977. And you'll see that there's a lot of fluctuation in bond returns, but there are very few losses. Here's the zero line. And this is a loss year. This is a loss year. And most recently, this is a loss year. But that's not very many out of 45 years. There are 3 years with losses. Now, what causes all these fluctuations here? If we think about what the interest rate has been, and we look at here, we're looking at the interest rate on Treasury bonds. That interest rate has, over the period of time that we're looking at, mostly been declining. And if you look at the trend of the Barclays return at the gray, you can see that that's kind of declining too, right? But there's a lot of fluctuation that the interest rate itself does not explain. So let's think about what we said earlier, which is that interest rate changes can also affect total return. So let's move to looking at what happens when, or what's happened to the interest rate. You see that there are changes here in the blue line. It does go up and down a little bit. So let's look at the changes now. And the yellow here shows the changes. And it's not that they're larger than the changes that we saw in the previous slide, because we've multiplied them, we've made them bigger, and we've multiplied them by the duration. And we'll talk about what duration is and why we use that as the multiplier in the second part of the webinar. But for this purpose, I'm just trying to show you that changes in interest rates can influence the returns for the Bloomberg aggregate. So our estimate of the bond price changes based on the changes in the interest rate, this 10-year constant maturity interest rate, which is this is a Treasury bond interest rate. Our estimate of the price changes is shown by this orange line. And there's a lot of fluctuation here. And if you kind of squint at it, it kind of looks like the same shape as the return on the aggregate, but it's not as high. And the reason is that the total return for the aggregate is the sum of the coupon, the interest rate, which was that we're estimating with that constant maturity yield, and the price changes. So suppose that we add them together like so, and voila, there we are. So it's imperfect, and it's imperfect because we're using one interest rate, which is a Treasury bond interest rate and a 10-year Treasury bond interest rate at that, to approximate the interest rates for all the bonds in the Bloomberg Barclays aggregate. And there are lots and lots of bonds and lots of different interest rates, but that's not too bad. I mean, you can see that we've accounted for a lot of the movements in returns with just those two pieces of information: the return or the yield on that 10-year maturity bond, and changes in the yield on that 10-year maturity bond. And importantly, there are no defaults here. There's no failure to pay. This is just interest rates rising, and lenders, owners of bonds, saying, I wish that I'd gotten the higher interest rates once those higher interest rates appear. So bonds are risky, but not nearly as risky as stocks. Here we're looking at quarterly returns since 1976 for the S&P on the left in green, and for that Bloomberg US Aggregate Bond Index on the right. And you'll notice that the quarterly returns for the bonds are kind of in this, they're under 5%, and for the most part, these are quarterly returns. For the most part, they're above -2.5 or so. Whereas the stock returns, there's lots of quarters at 15%, and there are lots of quarters at -10 or more. So there's much more fluctuation in return for stocks than there is for bonds. Bonds are risky, but not nearly as risky as stocks. So stocks have many more negative return quarters than bonds, much larger negative return quarters than bonds. And you might say, I would say, couldn't we avoid those negative bond returns? It looks difficult. There's lots of fluctuations, just like stocks, but shouldn't it be easier than stocks? We're only dealing with interest rates, right? And the Federal Reserve controls those interest rates. So let's look at that. So we're looking here at Federal Reserve changes in the federal funds rate. That's the interest rate that they can control. That's down here. And changes in that 10-year constant maturity treasury bond rate on this axis. So each point, so let's pick a point here. I don't know what the date of that point is, but that says that they changed the federal funds rate by a lot, right? They increased it by 1.5%. And we're looking at, I can't remember, this is as many years of Federal Reserve, federal funds rates changes as I could find. I think it's 30 or 40 years worth. So in this particular month, they increased rates by 1.5%, and that 10-year constant maturity bond rate actually went down. So the control that the Federal Reserve has over all interest rates is limited at best. And if you look at this graph, you say, if there was if there were perfect control, you'd expect a line that would look like that. In fact, it would go from 1 through 0 up like that. And you can squint at it and say, yeah, that's kind of what it looks like, but there's a heck of a lot of dispersion. It's not a tight fit at all. And if we do statistics on this to see if maybe there's a relationship that we don't see or that we can't visually pick out, we get a very small explanatory power. We can explain about 12% of the variation in that 10-year constant maturity rate with changes in the federal funds rate. That's not very high. That says that there's not much of a link. There's some, but there's not a lot. And it's also contemporaneous, right? So it doesn't do us much good to know that when the Federal Reserve raises rates, that the constant maturity rate also goes up, because it's pretty much simultaneous. And we got to know in advance if we're going to do something. And secondly, the fact that there's such a weak link between what the Federal Reserve is doing and what's happening to that longer interest rate is that there are other factors that are important in moving the 10-year constant maturity rate: supply and demand for credit, general economic activity. So there's a lot going on that the Federal Reserve doesn't explain. Okay, so ideally, what we'd like to do is we'd like to sell just before interest rates rise, we'd like to buy exactly when interest rates stop rising, but if interest rates are rising slowly, we might get better returns than cash just by holding on and holding our bonds. So is that possible? Is it possible to do that? Well, we looked at what the Fed is doing and as a predictor of interest rate movements and found that it wasn't that helpful. We could look at other factors to predict what interest rates are doing, and we'd find that they're not that helpful either. So knowing Federal Reserve policy, which all investors do at approximately the same time, isn't enough. And you've perhaps heard us talking about how the market for stocks is pretty efficient. The market for bonds is pretty efficient too. There are a lot of participants. They're all avidly interested in the direction of interest rates. They pay a lot of attention to it, and it's not easy. I would say it a little differently. Making money by market timing bonds could be really lucrative. I like to say you could make private island money if you could do it, but lots of people are working really hard at it, and the competition makes even moderate success extremely unlikely. So if only we could do it, we could make a lot of money, but there aren't a lot of people. I'm saying there aren't a lot of people because somebody might come up with someone who does, but there aren't people that are making a lot of money by forecasting interest rates and trading on them. Okay, so Bobby, at this point, if we have any questions, we could take a few.
Oh, Rick, we have many questions. Okay, our first question is from Jean. Why is the Vanguard Tips Fund going down in value when inflation is increasing?
The Vanguard Tips Fund responds to, and tips in general, respond to real interest rates. So even though inflation is increasing, real interest rates are also rising. And so that means that just as with nominal bonds, when nominal interest rates rise, the prices go down. With inflation protected bonds, when real interest rates rise, their prices go down. So real interest rates have been rising somewhat. And so the TIPS fund is declining in price.
All right. Our next question is from Mark. How long does it generally take for intermediate and short-term bond index funds to recover from interest rate increases as new bonds with higher interest rates come into the mix?
That is an excellent question. And I'm afraid that I'm going to give the answer that it depends, because it depends on how long and how much interest rates rise. And if interest rates continue to rise, then the new bonds that come in will raise the yield, right? But then their interest rates will also be exceeded by the rising rates. So there's no simple answer to that. But if interest rates do stop rising, and there is a sort of a practical limit to that, then bondholders will benefit.
Our next question is from Jan regarding zero coupon bonds. How do I, as a buyer, lose if I wait a week to buy a zero coupon bond and interest rates go up? How is this risk particular to zero coupon bond?
So it's that risk is not particular to zero coupon bonds. The cost of waiting for purchasing any bond is the return that you give up by waiting. So in the case of a zero coupon bond, waiting a week, you're giving up the increase in price that you would have gotten, because those zero coupon bonds, if interest rates do not change, then the price of the zero coupon bond rises as time proceeds. Imagine that you're a week before that $1,000 payment is due. That bond, that zero coupon bond, is going to be worth almost $1,000, and coming up from 905 if interest rates are 1%, or 820, I think it was, if interest rates are 2%. Right, so the bond price, the zero coupon price, is going to increase slowly and smoothly over that, in this case, the 10 years. So if you knew interest rates were going to rise from 1% to 2%, then you'd only be giving up that 1 week's worth of price increase. But of course, you'd have to know that interest rates were going to rise.
All right. Our next question. Albert is asking you to comment on the question of bond funds versus bonds as investments.
Another excellent question. A little bit complicated, but one way to think about it is that when you buy bonds, there are transaction costs. And if you are buying, most individuals who are buying bonds are buying small quantities of bonds relative to the market for those bonds. And therefore, individuals who are buying individual bonds are likely to face somewhat higher transaction costs than a bond fund would face. So in general, people who are buying bonds are going to do better for themselves by keeping the transaction costs down and by buying a bond fund. As we'll talk about a little bit later, if the stream of payments that you're trying to fund with your investments doesn't match well with the holdings in the bond fund, and we'll be really specific about what we mean by that in the second section of the webinar. If there's a mismatch there, then it may be worthwhile to incur those extra transaction costs so that you get a better match between the payouts that the bonds are making and the payments that you yourself are trying to fund.
Our next question is the interest deposited in your brokerage account semi-annually or accumulated when sold or maturity?
So if you hold the individual bond, then the payment comes to your account. And if you're holding bond funds, those interest payments are distributed by the bond fund, usually on a quarterly basis. And then whether it comes to your brokerage account or whether it's reinvested in the fund depends on the instructions that you give to your broker.
Okay, our next one seems like more like a comment, but for the rate on original issues treasuries, the rate is set by the public in treasury auctions. The Fed funds rate is to member banks. There's not tight correlation. I'm not sure I understand that one, but over to you, Rick.
That's absolutely true, and I think that illustrates the limits of the Federal Reserve's ability to control interest rates other than the federal funds rate. Not only are rates at issue set by auction, but rates in the marketplace are set by trading. And the Federal Reserve doesn't control that either.
Okay. Our next question is from Mike. With bond and stock returns falling, what is your opinion of the 60-40 portfolio?
My opinion is that people should select their asset allocation based on their risk capacity and their risk tolerance, and that the portfolio that is right for them is unlikely to change based on month to month or quarter to quarter or even year to year changes in investment returns, either in the bond market or in the stock market. And that people tend to think that it is important for them to respond to changes in market conditions by adjusting their portfolio. And in many cases, we subscribe to the view of that could be expressed as, don't just do something, stand there. That it's wise to recognize that as an individual investor, your requirements don't change when market conditions change. And you've chosen your portfolio based on your requirements to work for you throughout a very wide range of market conditions. And these market conditions are not outside the range of market conditions that one should expect.
You have a couple questions here on laddering. So the first one is, does
Oh, okay,
laddering
Bobby.
bonds?
Bobby,
Yep.
I'm watching our time here,
Okay.
and I think that we should return to the presentation, and then we can come back to questions on laddering or to other questions that may be more specific to the second part of the webinar. And laddering, I think the second part of the webinar will speak to directly.
Fabulous. Over to you.
Okay. Okay. So, and in fact, we're going to speak about laddering and how it might be helpful or how it might be relevant right now. So, when you think about your investments, in large part, they are you have them to help you fund payments that you expect to make in the future. And it's useful to think about those payments and think about them as liabilities on your balance sheet. And let's think about a particular payment now. So suppose that we're going to make a payment of $1,000 10 years from now. And the question is, how much money should we set aside today to fund that payment? And it turns out that the answer is, it's going to depend on the interest rate. We want to set aside what's called the present value of that payment. And that present value is going to be lower depending upon if interest rates are higher. So if we're planning to make a $1,000 payment 10 years from now and interest rates are 1%, and we want to know how much we should set aside, we should set aside $905. If interest rates are 2%, we should set aside $820. If they're 5%, we only have to set aside a little over $600. So the interest rate directly affects how much we need to save, to set aside. And as interest rates rise, the present value is smaller. Okay, so now let's think about a particular payment that we are funding with a particular bond. So suppose that we've got a payment that's due of about a little more than $1,200, and it's due in 20 years. And suppose that the interest rate is 2%. And we say, okay, we're going to fund that. This is like laddering now. We're going to fund that with a bond. It's a 10-year bond. And so, but if we buy a 10-year bond at 2%, and we plan to buy another 10-year bond at 2% when that one matures, we'll have exactly what we need to fund that payment in 20 years. Now, suppose that we then, unfortunately, suffer a rise in interest rates, okay? Notice that the amount of money that we would have needed to set aside to fund that payment, if interest rates go to 3%, we could have gotten away with setting aside less in now than we had to set aside at 2%. And notice, though, also that when our bond matures, we're going to get $1,000, and we're going to be able to reinvest that at the higher interest rate. And in 10 more years, we'll have more than we need. So we've got a surplus. Even though interest rates have risen and this bond has become worth less, we're still better off because we're going to be able to fund the payment that we wanted to make, and we're going to have money left over. So the rise in interest rates actually helped you, even though the value of that bond that 10-year bond went down, right? Because it's dropping. You can see it's dropping like a little bit each year, or it's dropping a lot early on, but out at 10 years, it's worth exactly what we expected it to be worth. Okay. Now, suppose that we do it the other way around. We've got a payment that's due in 10 years, but we buy a 20-year bond to fund it. And again, interest rates are 2%. We bought a 20-year bond, and we're planning to sell it in 10 years so that we'll have just enough to pay off that payment that we want to make, which here is sort of $850 or something like that. Now, suppose again that interest rates rise. Now, we could have gotten away with a smaller investment, but our bond is worth less. Remember, it's not going to be worth the full $1,000 until 20 years out at 3%. And so if we say, well, we're going to sell that bond in 10 years, we're going to sell it right here, and we're going to be short, right? We're not going to get the amount that we needed to make the payment of $850. We're only going to get $770 or something of that sort. So the rise in interest rates hurts you. Same rise in interest rates from 2% to 3%. But because the bond, in this case, had a longer maturity than the payment we planned to make, we're worse off. Whereas in the first case, where the bond was shorter than the payment that we planned to make, we would have been better off. So if we go back to the question for just a moment about laddering, if we have bonds that are laddered to produce payments at exactly the time that we want to make payments, then we're matching the maturities of the payments and the bonds, and we're immunized against interest rates changes. So here we are. This is the people who asked about laddering, or I must have read my mind. So suppose that. So now we're going to put together bond price and present value. Bond price for a $1,000 payment in 10 years, and the present value of the payment that we've got to make in 10 years. And notice that the bond price for a $1,000 10-year coupon bond at 1% is the same as the present value of that $1,000 payment 10 years in the future at 1%. So when interest rates rise, bond values and present values move in tandem, right? So as interest rates go from 1% to 2%, the value of that bond that we bought goes down, but the present value goes down by the same amount. So once you've bought the bond, interest rate changes don't affect your ability to fund the payments. This is the argument for laddering. Now, if interest rates rise, you might wish that you'd waited to buy the bond, right? Because if we bought the bond for 905 and it drops to 820, the interest rate rises to 2%, and the value of our bond drops to 120. We could have saved $85 if we'd only known that interest rates were going to rise. So we would have more surplus, but we're able to fund the payment that we plan to make without any adjustment in our portfolio. So the question of shouldn't I have waited until interest rates rose, that's a market timing issue, and market timing is really hard. Okay, so let's consider your bond holdings in light of your entire situation. So let's look at a lifetime balance sheet. Here we're looking at a couple that has $4.5 million in future earnings, $500,000 in a house, $500,000 in stocks, and $500,000 in bonds. And they have a mortgage for $200,000, other loans for $100,000, and future payments of $3.5 million. And those could be things like future mortgage payments, future tax payments, and spending that they intend to do in retirement. And they have a substantial surplus of assets over the spending that they plan to make in the future. Now, rising interest rates would reduce the value of their bonds and maybe their stocks too, but certainly their bonds. But it's also going to reduce the present value of the future payments. So do rising interest rates make them better off or worse off? And the simple answer is, if the present value of your future payments goes down more than the value of your bonds, your net worth actually increases. So rising interest rates could increase your net worth. How can you tell? How do you know if rising interest rates are good for you or not? And the simple answer is in what's called duration. And duration is also a characteristic of bonds. And unfortunately, it's not printed on the bond, and it's not reported by the issuer of the bond. But we can think about duration of a zero coupon bond. We can think of duration of a bond fund, and we can think about duration of your future payment stream. And we're going to do that in just a moment. But if we just think about what the definitions are, so the definition of duration is the time until the average arrival date for a bond fund. It's all future interest and principal payments. So what's the average arrival date, or how long is it to the average arrival date of the future interest and principal payments? And for a payment stream, it's the average due date of that future payment stream. And it's not a simple average, it's a weighted average. So big payments or big payments out, or big influxes of payments from the bond issuer are going to get more weight in the average than small ones. So with a bond, the biggest payment is the return of principal. And so that's going to pull the duration longer. Okay. And that's also going to be the approximate percentage decrease in the price of the bond fund or the present value of your future payment stream for a 1 percentage point interest rate increase. So when we calculate the duration, we also get a sense of what the approximate percentage change is in the price of the bond or the bond fund or the present value of your payment stream into the bargain. That's why that's a reason that duration is such an important concept. If durations are short, the impact on bond prices and present values are small. Suppose you had a 2-day bond. You buy it on Monday and it matures on Wednesday, and the interest rate changes on Tuesday. That's just not going to have much impact because you're getting the principal on Wednesday, and you'll just buy a new bond on Wednesday and you'll get the higher interest rate. So there's very little impact on a bond with, let's say, a 2-day duration. But with long durations, interest change impacts are much larger because you have to wait longer to reinvest, and that's really the import of duration. So let's do a simple example. Suppose that we have a 5-year bond. So it's a 5-year bond. It's issued in June of 23, and I'm sorry, it's issued in January of 23, and the first payment is due 6 months later, half a year out, and it's a 5% bond, and so it's getting, I'm sorry, it's a 10%. It's a 10% bond. I don't know why I did that. We're paying $100 a year, right? So it's a 10% bond, and notice that we weight the payments, right, by how far out they are, and then we get on the last day, the maturity date out at the end of 2027, we get both a principal payment and an interest payment, and so that contributes a great deal to the weighted average, right? 5,200 out of 6,375 almost. The total payments are 1,500. The weighted payments are 6,375, and the duration of this bond is 4.25. So it's less than 5 because the coupons pull the average down, but it's more than 2.5, let's say, which would be the average of 0 and 5 years. It's more than 2.5 because of the large payment at the end. Okay. So the longer duration means that there's a larger value decline in the bond with a larger duration and in the payment stream if interest rates rise. So if the duration of your bonds and the duration of the payment stream is relatively comparable, then rising interest rates don't have much impact, right? This is kind of a laddering situation where you've got the bonds and the payments pretty well matched up. If the bonds are shorter than the payment stream, as we saw in our example, then you're going to get a surplus when interest rates rise because you're going to get to reinvest before the payments out are due, and you're going to get to reinvest at the higher interest rate. But if the bond, here's that, I'm illustrating here, right? Interest rates rose, we get a surplus. But if bonds are longer than the duration of the bonds is longer than the payment stream, then we're going to have a shortfall. And again, that the example that we used with the 20-year bond and the 10-year payment due date illustrates that. So here's the 20-year bond, the payment due at 10 years, and we've got a shortfall when we have to sell the bond early. So, well, let's think about some common situations, and let's think about bonds that we have in our portfolio. So here are the bonds that many of our clients have in their portfolios. These are bond funds, I should say. We have a foreign bond fund, a TIPS fund, a short-term TIPS fund, investment-grade corporate bonds, mortgage-backed bonds, and these are the tickers of the bonds that we use, and these are the current durations. The weights in a standard bond portfolio, and this is the weighted average duration. And this is the weighted average duration for global portfolios is 7.1, 7.1. For US portfolios, it's a little bit shorter. It's just under 7. Well, what about the payment stream durations? Let's think about a couple of common ones. So one is college funding, and one is retirement planning. So for college funding, we've said that we're going to have 4 equal payments starting at 18. That's an approximation, but 4 years of tuition and fees for the standard high school graduate starts at 18, goes through 21, 18, 19, 20, 21. So if that's the situation for a child who's just born, the duration of that liability is 19 and a half. And as time goes on and they get closer to going to college, the duration goes down to the point where when we're in the middle of college, the duration is under 1. Now, a second stream that we can think about is retirement funding. And here we're assuming that there are 30 equal payments starting at age 70. So somebody who's fully retired at 70, planning to live to 100, and we can calculate the duration there as well. And for someone who's 25, that duration is pretty long at 60 years. But even for someone who's 65, the duration is 20. And even for someone who's 80, the duration is over 10. So if we compare the durations of these liabilities to the durations of the bonds that we talked about, here's short-term TIPS. Here's short-term TIPS down around 2.5. And here's the average of our longer bonds at 7-ish, and that's between 10 and 15. But so for children who are 12, let's say, this would be fine as the date of college approaches, if we're funding with bonds, we want to shorten up the duration. And in fact, we do that for clients who have bonds in their 529 accounts. Now, what about retirement? Here's short-term tips down here at 2.5. So even for a 95-year-old, short-term tips are not going to be too long, but these would likely be too long. So somewhere between 85 and 90, we might want to be shortening up the maturity, the average maturity of the holdings that we're purchasing for people in that age range. But it's a long way out before duration becomes a problem. If we're thinking about durations of bonds in your portfolio versus the durations of the liabilities that you're trying to fund. Okay, so all of that said, when interest rates rise, should you sell your bonds and sort of wait for things to get better? You could sell your bonds and hold cash, and that's good because cash won't go down in value when interest rates rise. But getting better return from this option than simply holding bonds requires really good market timing, as we suggested in the first part of the webinar. Buying higher yielding bond funds, which might have positive returns even if rates rise, right? Because remember that the total return is the coupon plus the price change impact or the rate change impact. So if we start with a higher coupon, then a given rate change might not be large enough to drive the return negative. But you're taking on more credit risk when you do that. You're taking on more risk of borrower default. And you may not receive enough extra return to compensate for the higher risk. And if your portfolio is well designed, taking on more risk may throw it out of balance, your portfolio out of balance with your long-term plan. And finally, you could buy, and this is a really common idea, go buy low risk, high dividend stocks, right? That'll give you a higher payout. Two issues with that. One of them is that dividend stocks, to the extent that they're like bonds, respond in the same way to interest rate rises as bonds do, right? So if you've got a regular stream of dividends and interest rates go up, that stream of dividends has a lower value. And secondly, you're taking on stock risk. And again, your portfolio is designed to provide you with the right balance of risk throughout market cycles, across market cycles. Okay, so what should you do? Even though interest rates are relatively low now, even though they've increased, and increases are likely to continue as the Federal Reserve attempts to respond to inflation and perhaps market activity, not stock and bond market activity, but economic or broader market activity increases. Conventional wisdom about your best response is at best misleading and can actually be helpful. It can be harmful for several important reasons. First of all, the time pattern of interest rate increases is completely unpredictable. We don't know when, by how much, interest rates will increase. So selling bonds to buy shorter maturity bonds, to hold stocks, to hold cash, in the hope of better returns, it's market timing, and that's generally not advisable. Secondly, while the immediate impact of rising interest rates on the value of your bond and bond fund holdings is clearly negative, its impact on your overall financial position is less clear. If you happen to hold individual bonds with maturities that are matched to your future spending, if it's laddered that way, higher interest rates don't affect your financial position, your net position at all. If the duration of your payment stream is longer than the duration of your bond portfolio, and that's true, I've suggested for most people, higher interest rates actually improve your position. If the duration of your payment stream is lower than the duration of your bond portfolio, higher interest rates are unfavorable for your financial position, and you might want to adjust your bond holdings accordingly. Okay, so at this point, we'll take more questions, and we're running a little late, Bobby, but let's do what we can.
Yes, and we have many, many, many questions, so we definitely will not be able to get to them all. One of our questions here is, do bond funds buy and sell bonds before maturity, or do they hold until maturity, and therefore what we are seeing is a change in valuation or a real loss?
So most bond funds, most of the bond funds that we hold buy and hold bonds. They may sell them when they get to a year maturity or less, but that's a small effect. So I think it's reasonable to think of them as buying and holding rather than trading actively.
Okay. If considering a bond ladder purchase, is it better to wait or plunge ahead in a rising interest rate environment?
That's a difficult question. It's a market timing question. There's no good answer to a market timing question. I think that if we were thinking about stocks, we'd say something like dollar cost average. And I think the point of that is not that you're likely to get a better financial outcome. It's that emotionally you're going to get a better outcome because you're less likely to have big regrets. So I think that would be my response here as well.
All right. Our next question. If fluctuation of bonds, though small, is too risky for investors, where should investments go?
Investment is risky. There are no risk-free investments, or precious few. The closest thing that we have to a risk-free investment is I bonds, and investors are restricted to buying no more than $10,000 a year worth of I bonds, and that's not a practical solution for most people. You could buy a short-term tips fund that's going to have relatively low risk, and that would be another good alternative, I think.
Okay. Bond ladder investing sounds actively complex. Are there ETFs that do this automatically? And are there any downsides of investing in those other than fees?
There are bond funds that have specified maturity dates, and those are worth considering. I don't know that I've seen tips funds that are set up that way. I think I've seen municipal bond funds that are set up that way. So they're worth looking at.
Does buying floating rate bond funds make sense in the current environment?
It makes no more or less sense in the current environment than it does in other environments. I don't have a strong view on floating rate bonds. We don't have them in our portfolio, but I don't have a strong view on them.
Okay. We are being asked to comment on the effects of required minimum distributions on the choice of duration in retirement accounts for older investors who have no requirement for current income.
I think that's there. The required minimum distributions are sort of irrelevant, right? Because you can take the distribution and buy back the position. So it's your position could be unaffected. I think that required minimum distributions are a little bit of a, you may be more concerned about them than you need to be, because they are requiring that you pay taxes, and that's true. So that's a payment that you have to make. But roughly speaking, you can replace the position that you had to sell to take the distribution.
All right. And are you all set? Do you want to take one more question?
I could go a little bit longer. If there are lots of questions, it turns out, I could go another 15 minutes if there's that many questions.
Oh my goodness. Okay. So the next question would be, this analysis does not consider changes in interest and inflation, i.e. what happens when interest goes up, but payment requirements also change because of inflation. How does this factor into what you should do overall?
Come back to the tips webinar.
All right. That sounds like a good idea. And folks, if you are interested in registering for those webinars, we will be sending out information to take you right to the website page. Next question is, to what extent are assumptions about future interest rate increases already embedded in the terms of the bond?
They should be, that the market's assessment of future interest rate, future federal funds rate increases are built into the bonds. People watch the Fed like hawks and parse each sentence of every Fed statement carefully and discuss them back and forth. And so I think it's safe to assume that attempting to read the Fed's statements and somehow outsmart the market it's going to be pretty tough.
Our next question is from Tim. Is there a historical inflationary period that one could look to compare our current circumstances?
I would say no. I mean, I think that it's often instructive to look at history and to see what went on and to see, if you will, what can happen. But there are people who spend a lot of time reviewing previous history and attempting to interpret it, and they find it difficult to agree. There's sort of no shared perspective on for example, if you were trying to say, well, let's look at inflation. How long is inflation going to last? How high will it get? How fast will it come down? And if you're attempting to look at history as a source of information to help you predict that better, I think that would be very difficult to do. I think conditions are now substantially different from conditions that we faced in other eras in important ways. So it's always interesting to look at history. I think it's risky to attempt to use history to project what's going to happen.
Our next question is from Marvin. What's the point of holding bond funds if it can lose value versus owning bonds directly?
Bonds lose value directly too. I mean, if you hold bonds directly, they lose value too. If you were holding individual bonds and you looked at your brokerage statement, you would see that the value of those individual bonds was down as interest rates rise. And you can say accurately that the promises that the issuers made about interest rate payments that they're going to make, or interest payments that they're going to make, and principal that they're going to pay, they're going to continue to do that for individual bonds. But the same is true for bond funds, that the issuers are going to make those interest payments, and they're going to make the principal payments. So the changes in the prices of the bond funds reflect the changes in the prices of the bonds that they hold. And you can't avoid changes in value of a price of bonds by holding the bonds instead of bond funds.
Our next question is from Mike, who is comparing investing in bond funds versus purchasing bonds directly from the Treasury, such as I bonds and EE bonds. What's your opinion?
The I bonds you can't buy in a fund, so that's a I'm very much in favor of I bonds especially as a place to hold cash and cash reserves. But as I said earlier, the amount that you can buy is limited, and for many investors, that's an important restriction. I don't know what else to say about the bonds versus bond funds that I haven't already said. Bond funds provide convenience. They provide efficiency in transacting, and individual bonds allow you to maturity match with the spending that you want to do, and bond funds don't allow that. I think those are the important differences.
Our next question is Norman would ask you if you would recommend CD laddering with purchases tied to the Fed interest raises.
The laddering that we recommend, if you're going to do laddering, it's most useful to ladder so that that bond maturities match the spending that you want to do. If you're laddering without reference to spending that you're planning to do, then you're basically market timing, right? And you're market timing your reinvestment. So if you buy CDs then you have a reinvestment point when the CD matures, and you've got the risk of what interest rates will be then. And that's true of any holding. And there's nothing special about CDs, and I think there's nothing particularly special about the dates that the Fed is perhaps going to announce interest rate changes.
Bob would like to know, is owning a bond ETF or mutual fund similar to buying a ladder? If not, how does it differ?
So no, it's not similar to buying a ladder, because the bond fund never matures and the ETF never matures. Whereas the holdings in the ladder, if you have bought the ladder to fund payments that you need to make, then that ladder immunizes you against interest rate changes. If you are buying the ladder simply as a way of reinvesting, right? If you buy a ladder of bonds so that a certain percentage matures each year, but then you're going to turn around and buy more bonds. There's no special advantage to that, and you're probably better off with a bond fund because you're going to have much higher transaction costs if you're buying a ladder than if you're buying a fund.
Leslie is saying, it seems as if most RIAs prefer using bond funds rather than ladders. Why is this?
Bond funds have lower transaction costs, and they're easier to trade. And if the ladder is simply a method of managing your reinvestment, so you buy a 10-year bond, and then next year you buy another 10-year bond, and then the year after you buy another 10-year bond, so you have 10-year bonds maturing every year, but you're going to then reinvest the proceeds in another 10-year bond, then you have no advantage relative to a bond fund. It's just you're timing the reinvestments a little bit differently, but there's There's no special advantage to that. The advantage to laddering is if you maturity match the bonds to payments that you're planning to make. Then there is that we can specify, or we can say that you're immunizing yourself against interest rate risk when that matching occurs, as my example illustrated. But without that, there's no special advantage to a ladder relative to a bond fund.
Jean would like to know, does buying floating rate bond funds make sense in the current environment?
I think we answered that question.
Okay. All right. This one says, I sense that this duration analysis might apply to RMDs over the years. Could it apply?
I think that depends on whether, I say it differently. The duration analysis applies to spending that you are trying to fund. RMDs specify dates on which you have to pay taxes. Fundamentally, that's what they're doing. And to the extent that you said, well, I want to, I can predict how much my taxes are going to be, and I'm going to buy bonds that will mature exactly when those taxes are due so that I can pay the taxes, then there's some maturity matching going on there. But otherwise, the RMDs are not aligned. In general, they're not aligned with spending that you're planning to do. They're simply the government saying you must take money out of a retirement account and pay taxes on it. And so there's a tax payment that has to be funded. But then what you do with the money that comes out of the account influences whether there's benefit to maturity matching the rest. So in general, we encourage people to focus on the spending that they're planning to do rather than on the RMDs, because the relationship between the two is usually limited.
All right, we're getting down to the end of your time available here, Rick. Do you want to draw this to a conclusion?
Yes, let's do that. Okay, I'm going to go back to my pointer here. Okay, so takeaways from this. All assets are risky, including bonds. Bonds are safer than stocks. Bonds represent promises to pay interest and return principal. Higher interest rates are more attractive promises, and therefore the prices of old bonds at lower interest rates decline. The total returns of bonds include the interest payments and the price changes. And unfortunately, interest rate and bond price changes are unpredictable. Higher interest rates are good for lenders, and bond owners are lenders. So if you own bonds, holding or keeping in mind the duration implications or the duration considerations, but in general, higher interest rates are good for people who own bonds, even though in the short run, the prices of your bonds come down. And bond alternatives are not better than bonds. They're just different. So if you say, well, I'm going to sell my bonds and buy cash, cash isn't better, it's different. It has different characteristics. If you say, I'm going to sell my bonds and buy dividend-paying stocks aren't better. They're just different. They have different risk characteristics. And it's best to set up your portfolio for your life rather than for current market conditions. Okay, so that concludes today's webinar. We're going to talk about tips in the next one. That's coming up on June 23rd. We hope to see you there. Thank you very much for coming. And again, the video will be available online shortly.
Thank you very much.